Hello everyone, I'm Lee Pacchia and this is Bloomberg Law on Demand. We're taking another look at the situation regarding Fannie Mae and Freddie Mac today. I'm happy to say my guest is the Jonathan Miller. He, of course, is the president and CEO of Miller Samuel. It's a real estate appraisal firm based here in New York City. He's also a prolific blogger and user of the social networking site Twitter. Jonathan, thanks so much for coming in today.
Oh, great to be here.
I want to get a little context on this issue before we jump right into the nitty-gritty. Just exactly what is Fannie Mae, Freddie Mac? We've been talking about it a lot lately. What does it mean to the residential real estate markets in this country?
Well, I think it means pretty much everything to it at the moment. About 90% of mortgage money flows through in some aspect through Fannie and Freddie in the form of guarantees or buying mortgages from lenders. So it's critical, and their market share has increased because the private sector, after the onset of the credit crunch, essentially when Lehman went under, disappeared or evaporated.
It's been a rough 3 years. Where today are the residential real estate markets? On the mend or?
Yeah, I think you'd say that on the mend means, the word recovery used to mean getting better. I think recovery now means not getting worse.
Right.
And I think that's the way you look at housing, as we've had tremendous gyrations in volatility in 2010 with the tax credit the first half of the year versus the second half of the year. A lot of the national metrics being reported are really lagging the current market, but essentially you're looking at sales activity essentially stabilizing but still well off peak, and prices not falling. In a general sense, some markets are, some aren't, but stability, I think, is the word at the moment.
Interesting story out today on the price of the 30-year mortgage bumping up over 5%. Not a huge number in the scheme of things, but that's a pretty substantial increase. Do you see a continuation of that trend, and what is that ultimately going to mean to the market?
Well, without a doubt, I see it as a trend, maybe not at the rate it's gone over the last couple of months. But look, rates are managed artificially low. That's another form of stimulus to get housing going, and that is not going to be sustained indefinitely. They're still at historic lows. We're not expecting any surprises, but the housing market is keyed into it. So as you raise the cost of borrowing, even though affordability is at an all-time record, you remove people that would qualify either for refinancing out of a challenging situation or actually purchasing. So I think it again places more downward pressure on housing over the next couple of years.
So it's not huge news, but it's something to keep an eye on?
Yeah, I think it's more like a sort of a slow water torture as far as the housing market goes. It's going to be a while. I think the good news is that we're not seeing the massive volatility that we had over the last couple of years. The bad news is that we're not really done. We still have a lot of issues to deal with. One is Fannie and Freddie, foreclosures, elevated unemployment, tight credit, all those things play into housing.
Right. And news out this week from Bloomberg News, we're starting to see a little bit of movement on the Fannie and Freddie front.
Yes.
U.S. Treasury Secretary Tim
Finally.
Geithner is going to go before Congress tomorrow with, I wouldn't say a proposal, it's more like a white paper, but some documentation or ideas on how to approach the situation. What do you make of this news? What's in there?
Well, first of all, I think that the approach is smart in the sense that you can't sort of ram a concept down Congress's throat. I think what they're trying to do is float a bunch of ideas because the stakes are so high. If they aren't careful, they could provide a significant problem for housing going forward.
Does that account for the extended time frame we've been dealing with this issue on? I mean, it seems like this has taken quite some time. We've been reporting on this issue for about 2 years,
right? And
it's almost dragging along at a snail's pace.
Yeah, I think it is, but I think part of it is because it's just such a huge problem that it was maybe easier to work on other issues first. And the other thing is, I think that no solid ideas have been really discussed or come out of it. So I think it's perhaps taken this long to figure out what to do.
What do you think Secretary Geithner is going to put on the table when he goes to Congress?
Well, my guess is there's going to be a handful of options. They're going to range from the status quo to 100% private, and I think my guess would be we're going to be somewhere in the middle, because the whole idea, I think, is to get the private sector back into the mortgage market. You can see that on the jumbo side, that it's essentially the capital markets filled that role. They're out of the game. But the problem is that I think you're going to need some sort of federal backstop in order to at least get this going. So the question is going to be, how much exposure is the taxpayer going to be subjected to?
Now, Fannie and Freddie, it's my understanding they essentially do two things. They originate mortgages for consumers, and they also guarantee those obligations. Lots of the debate has focused around guarantees.
Yes.
Where do you think that debate is going to ultimately get resolved, and how do you think they should resolve it?
Well, I think the guarantees are going to me, the key issue is going to be with or without that implicit guarantee.
Right. I mean, it could either become an explicit guarantee or it could just be abolished.
Right, exactly. But I think if it's abolished, I think we're beyond that point. I don't think that the private sector is going to jump in if there's not sort of
right.
some
So the guarantees have to stay
behind it. I would think that would be a reasonable expectation.
So what do you make of the direction we're heading? Is it ultimately a positive direction, or?
In terms of housing itself, I think we're going in. I wouldn't characterize it as positive. I like, my favorite phrase of the last 6 months has been moving sideways, in the sense that it's not getting worse. There are certain components of it that are getting better, but the mortgage market itself is essentially broken, and so we have to come up with, unless we suddenly decide to start paying all cash for housing in the U.S., I think the mortgage component is key, and it's something that if that's not fixed, housing as a asset class isn't going to recover until that happens.
What would you like to see most happen in the next 2-3 months?
Well, what I'd really like to see is I'd like to see the private sector step in to the jumbo market, specifically because of the high-cost housing markets like you have in New York and Washington and Boston, urban metro areas, because they're at somewhat of a disadvantage because a higher proportion of the housing stock is high-end housing, don't even qualify for conforming mortgages. For example, in Manhattan, you're looking at about 60% or 40% of the housing stock is essentially above $1 million or require some sort of jumbo financing. And the terms for those, because there's no secondary market and the lenders are holding them in portfolio, are higher down payment, higher FICO scores, and it's more challenging for that market. Whereas in the Midwest, where virtually 100% of many markets would qualify for conforming, they have an unfair advantage, as you will. The mortgage market is truly a U.S. market, whereas the housing market is truly a local market.
So looking at it from the U.S. perspective, what does it take to get the private sector involved again in a way that doesn't involve so much government assistance?
Well, I think the first thing is that there has to be reforms on valuation or the way collateral is handled. There has to be something done with the relationship that the rating agencies have with Wall Street.
Do you see any political will for that happening?
No. So that's why I see this process as very long, gradual, and drawn out.
This could be another 3 years.
I think longer. I really do. I think housing itself is probably. I heard someone describe it as we're sort of at this in a sawtooth bottom where we're bouncing up and down. But it's really, I think, going to be. We're going to probably peak in foreclosures this year. At that point, we're only halfway. So we have a lot of sort of significant, difficult issues facing housing in general, just for investors to be in the market, to be comfortable about issuing mortgages. I mean, if you look at lending today, national retail lenders are essentially looking, when you deal with anybody that's getting a mortgage, they're really looking for reasons not to lend. I mean, it's truly AAA product that's being lent, and unlike the AAA, pseudo AAA that was done a few years ago. So in many ways, that's the good thing. We're moving forward towards a more AAA, more higher quality product. But we still have these massive legacy issues pre-2008, which is the reason Fannie and Freddie are hemorrhaging. If you look at the dollars going forward on loans that were issued more recently, they're breaking even. So we're still dealing with cleaning up the past. It's not behind. We haven't resolved that yet.
It's going to be a long time before we start to see any real traction here.
I think so, but I don't see it as an imminent collapse or anything like that. I just see it as the upward. I think this is a case in history where the economy is perhaps going to, instead of being in lockstep with housing, is going to lead housing. In other words, we're going to see the economy improve, I think, before we see housing because of the legacy problem.
Okay, and housing continues to go sideways in the meantime.
Correct.
That's the word of the day, sideways.
Sideways.
Jonathan, thanks so much for coming in. This was a pleasure.
My pleasure.
That's Jonathan Miller. He is the president and CEO of Miller Samuel, based here in New York. If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.